Actually, India's recovery post-COVID was pretty strong and much better than many other economies. Inflation went up during COVID, came down after that, then again went up during Ukraine war.
The markets are in this constant guessing mode as to when the Fed is going to start cutting rates.
While the top line growth of last year was not very impressive, it was only 7.5% in Nifty.
So the youngest cohort of the population is coming from UP and Bihar, 330 million people.
Is India shining story or India growing at 6%?
India is growing at 6.8, 6.5, 6.7. These numbers don't really matter much. It's a very broad range that one should be looking at. So 6 to 7% is what we're looking at from a range point of view. But in the near term, I think closer to 7% is a growth rate that India will be delivering and what India should expect over the next 5 to 10 years.
Although we are conscious about the risks which are there, but those risks, I think, is mostly related to investors who are investing at the index level. The famous quote of Warren Buffett, which he made during 2008 financial crisis. He said, when the tide goes out, only then you will know who is swimming naked.
Market Thalaivas brought to you by Sundaram Alternates.
There's always a lot of buzz created around the markets. Macros, company results, geopolitics, global developments, and the like. In all this buzz, the markets only whisper. The question then is, are you listening? We're here with Sundaram Alternates, where we dive into current market trends and discuss various investment strategies with seasoned veterans. Introducing a podcast series, The Market Thalaivas, brought to you by Sundaram Alternates, the pinnacle of expertise in alternative markets. Get exclusive access to the top-notch market experts to discuss the craft of investing, helping you uncover new and profitable ideas. So join us for Market Wisdom. I am Arjun Nagarajan, your host for today, in conversation with Madanagopal Ramu, Fund Manager and Head Equities at Sundaram Alternates. The markets have been quite phenomenal over the last 3 years. Just as you thought some normalization correction was at sight, you saw a fresh rally in the market again, and yet again. Earnings apart, the mind voice of most fund managers I used to speak to was like, whatever, let's not go against this market. Can you sort of help simplify for us what was sort of going on over the last 3 years?
Hi, Arjun. Thanks for hosting me. Arjun, I think we are talking about what are the major influences for the market for the last 3 years have been, because the trajectory of the market has been pretty significant post-COVID. And there are three influences which I think played out positively for market, particularly for the Indian markets. The first of them was actually India's recovery post-COVID was pretty strong and much better than many other economies, which also got supported by the formalization of the economy, which led to corporate earnings being much better than what was expected even pre-COVID period. So a strong recovery from the corporate profits supported by the economic recovery post-COVID. Some bit of it got help from other economies struggling to recover. That was one major influencer. The second major influencer was the flows itself. If you look at flows, you can segregate into two things. One is the initial set of flow was supported by the global central banks pushing a lot of liquidity post-COVID, which pushed asset prices across board, right? Even equities got support of it. But what happened specific to India, particularly in the last 1.5 years, was that China slowed down significantly. That led to allocation shifting to India, as we all know. On top of it, the market rallied with the support of foreign investors coming in 2022. In 2023, the domestic investors also came into the party. And together, I think the flows were substantially higher than what we would have thought about. And these two major influences played an important role in market recovery. Last year, particularly, one more thing happened. Macro level, we saw the commodity prices coming down, which led to the earnings surprising in pockets. And that overall led to the market further rallying from the beginning of 2023 as well. So overall, I think the flows played a major role, followed by India recovery story post-COVID, and then followed by, particularly in the last year, some of the other macros like commodity prices falling helped further to push the market one more leg up. So overall, these three influences. But what is important to keep an eye from here on is which of these influences are permanent and which of these influences are temporary, because that will decide the trajectory of the market from here on.
Active versus passive. This has been a constant narrative in the markets for a while now. Now, the last 2 years in particular have been quite challenging for active fund managers to beat the passives. But the question that comes in everybody's mind is why so? And how do we see this space panning out over, say, the next 3 years or so? Would you help us unravel that, Madan?
Great. That's a great question, Arjun. To understand this, we need to first understand what really leads to passives beating actives. Normally, it is attached to the macros. Whenever there is a large macro in play, when I say macros, I'm referring to interest rate cuts or interest rate increases, or oil prices, one of the major macro determinant for India from a short-term perspective, or it might be about a sudden spurt in economic growth rate, which was not anticipated, large commodity prices swings. These kind of things influence the overall market, right? Many corporates will participate in it, either on the positive side or on the negative side. Whenever those kind of large macro swings happens, you can expect the passives either underperform significantly or passives outperform significantly. Why last 3 years passives outperformed? Because you saw post-COVID, as I explained in the first question also, that the flows have been very strong, which itself is a major contributor to passive outperforming. And passive ETFs are also very strong, right? There was a lot of money flowing into India from passive ETFs also. So in that period, what tends to happen is the most underperforming stocks over a long period of time, given that money is continuously coming into the market and the fund managers are lacking option beyond a point to keep on putting money into the growth companies or stocks which are seeing high growth because their valuations are already gone up. They tend to get into companies which have dividend yield or companies where there is a good narrative. So that leads to the segment which has not been performing coming back. That's called mean reversion. When the mean reversion happens, and then this typically leads to passives doing much better. So the key is that whenever there is a large macro related variable in swing, and large swing, it's not a small swing, it's a large swing, you tend to see passives getting support. And after COVID, we saw a lot of them happening, right? The macros were swinging from one end to another end. You saw interest rates falling after COVID, and then interest rates swinging higher in the last 1 year. And now again, we are talking about interest rate cuts. Same thing happened with inflation. Again, inflation went up during COVID, came down after that, then again went up during Ukraine war. Again, now the China slowdown is helping the commodity prices to come down. So all these huge swings will create opportunities. During those periods, it's very difficult to beat, in our opinion, the passive funds. But where we are right now, when we look at it, what are the other major triggers left in front of us? I think commodity prices cannot fall further from here. We are all looking for an interest rate cut. Interest rate cuts are always good for equities, but a lot of it got factored in December 2023 when the market rallied 8% in a very short period of time. So our feeling is from here, as the flows moderate, as you see that market take cognizance about earnings also, and now that the valuation is not as good, as attractive as what it was a year back also, you will start looking at active fund managers getting into action. And more so, the active fund managers, focused fund managers will also start getting benefited. PMSs are known to be active and also focused with the concentrated portfolios. Therefore, I think once these macro swings normalizes, then itself the active fund managers should start beating the passive fund managers. An extreme scenario like commodity price goes up significantly from here, or China recovers strongly, and then that can lead to some bit of this flows going out of India to China sort of thing happens, then probably the active fund managers will get much more support from the market. Normally what happens is the tail in the indexes, the index have a large diversified set of stocks, right? The tail starts contributing a lot. That hurts the active fund manager during those periods, during my major macro swings. When the tail starts hitting them, which is what happened in 2018, 19, 20, the tail was not performing. Even 4-5 stocks do well for any fund manager. If he's running a large diversified fund, his tail will start hurting him at a point of time. So that generally helps active, particularly the focused funds compared to the passive funds. So passive or large diversified funds. So our opinion is, I think next 2-3 years, we will have a good period or platform to showcase earnings-based recovery in stocks and performance in stocks. So the active fund management should be starting to doing well in the next say 2 to 3 year time period.
Wonderful. That was really, really very helpful, Madan. Thanks a lot for that answer. That takes me to the next question. Now, with fresh all-time highs every few months, valuations are also seen hitting their upper bands. And naturally, there seems to be a lot of talk about market risks. Now, with such a backdrop, are there really any opportunities in the market? Should we be cautious and sit on the sidelines, or are we getting plain paranoid and focusing too much on just the risk? How would you go about this one?
Just on the risk side, given that valuation where it is at this point of time, if you look at flows as such, there is this general feeling that flows are given for Indian market and it is going to be structural. But I disagree with it. Flows are always cyclical. It is normal for the money to chase returns, right? So equities gave returns, money has come in. If equities don't deliver returns, then it is natural to expect money to go out. I will explain this with one kind of a pictorial thing. You know this game called blow ball game, where you hold on your breath and blow the ball lifts up and then stays in the air. Flows are like that for markets. And particularly when you take mid and small caps, the mid and small caps are illiquid. And when there is so much of money is chasing, that's what happened last year, right? Money was chasing in a big way. Right now, mid and small caps got almost 100% equivalent of AUM as flows in the last 2 years of where they started. And they have gone up almost like 5-6 times then from where they started pre-COVID. So a lot of money has come into the mid and small cap, which is illiquid also. So like the blow ball game, it depends on how long your investors are going to hold the breath. Then as the breath recedes, the ball will start coming down. That's what flows do to the market. Generally, we tend to think that it is always going to happen. It is difficult. It is a short term and it is a cyclical factor. It is a short term influencer, in my opinion. So that is a major risk for the market. And the risk plays out when the earnings starts becoming weaker. If you look at last year, the earnings was good, but it primarily came from margin story, which is a outcome of the commodity prices correcting because of China's slowdown. And the commodity prices, I don't think will further correct from here. Therefore, it is going to set into the base. While the top line growth of last year was not very impressive, it was only 7.5% in Nifty. And even in mid and small cap, it was actually adjusted for financials, it was much lower. Therefore, much of the earnings growth last year came from margin expansion story, which is now getting into the base. In that period, I think your earnings can get cut. When earnings gets cut, it can impact the valuations. I think that risk is very high in mid and small cap space because mid and small caps on a whole is not able to outperform Nifty from an earnings perspective for at least next year. In that scenario, if they trade at a significant premium, that premium will get lost. So that is the risk that I see in the market at this point of time, particularly mid and small caps. But having said this, as a country which is growing, do we lack opportunity? I think there are enough opportunities. But before I get into it, I would like to hear your view also on where do you think the Indian economy will be, what kind of range the growth will be. Is India shining story or India growing at 6%? Where is the growth is likely to be? So I'd like to hear your opinion, and I will add to what you're saying and link it to the opportunities that I'm seeing in the market.
So one thing that we keep talking about from an economy point of view is not to really get too specific on the numbers. It doesn't really matter if India is growing at 6.8, 6.5, 6.7. These numbers don't really matter much. It's a very broad range that one should be looking at. So 6 to 7% is what we're looking at from a range point of view. But in the near term, I think closer to 7% is a growth rate that India will be delivering and what India should expect over the next 5 to 10 years. So 7%, in and around 7% is a very reasonable number to expect. Now, one thing that is very important to acknowledge at this point in time is how manufacturing as a driver appears to have really come back. Pre-COVID, if you actually look at the drivers of India growth, manufacturing was a very feeble driver of growth. And if you look at the post-COVID economy, even the last 3 years, you're seeing that manufacturing has really turned around. Manufacturing is increasingly becoming a driver of headline GDP growth. Now, that gives you two positives. One, in manufacturing in itself gets stronger. Second, if you look at services, a very large chunk of services in India's GDP is directly linked with how well and how strong manufacturing momentum is. So the better manufacturing momentum there is in India, you will see a very ripple effect in services as well. The trade, transport segment, the finance insurance segment, the tourism and the hotel segment, every single part of that is very interlinked with how manufacturing does. Now, I'll just add one small bit here. So it's very important when you look at India GDP growth rates to sort of be a little imaginative and say, okay, what can take India to an 8% growth? So we all know that the key drivers of the economy is agriculture, industry, and services, of which industry and services are a very important segments. Now, let's do a sort of an imaginative exercise here. In the sense, if you look at two states in India, which is just UP and Bihar, you add the population of these two states, it roughly works out to around 330 million or so. That's the exact size of the United States. Now, what I'm not really comparing United States and UP and Bihar, I'm just trying to talk about how, if you look at UP and Bihar in combination, 330 million, where the average age of that population is barely 21, 22 years. Average age of India's population is closer to 28, 29 years. So the youngest cohort of the population is coming from UP and Bihar, 330 million people. And the entire demographic dividend, a very large chunk of what is going to play out in the next 20 to 30 years, is going to come from this segment where you're seeing increasingly growth rates picking up, you're seeing increasingly infrastructure activity picking up, you are seeing income growth picking up, which actually leads to the entire consumption story, the financial story, the aspirational story, all of that, which is very important for manufacturing also to drive GDP growth.
You made my life easier, Arjun. This is exactly what we feel also. We think manufacturing pre-COVID was a struggling sector. A lot of reforms were happening. And post-COVID, a lot of them are getting into action. We have to say that government has taken a lot of effort to streamline the incentive schemes to push the manufacturing sector and the corporates to invest in India on as an import substitution story. Also, in some cases, we are pushing and saying that we can start manufacturing electric vehicles here. We can start manufacturing semiconductors here. So, of late, you would have heard a lot about government coming out with a capital subsidy scheme to support, or even schemes which are fine-tuned to meet a particular sector like electric vehicle. Recently, Tesla showing interest in India, given that India is ready to reconfigure the PLI scheme itself to match the needs of these corporates. So we feel that government is taking a lot of effort to get at least import substitution story done and thereby supporting the manufacturing sector and involving many of these corporates into this. A lot of these corporates, domestic corporates like Reliance, Adani, Ambani, and if you look at Tata's, if you look at even the second-rank corporates, even South, we can see Murugappa Group making a lot of investment noise. You can hear that from many other corporates also. So as a country, we are involving our corporates to invest into India and also attracting global MNCs to invest into India at this point of time. I would still say it is work in progress. We have to see how these sustain and scale further because we cannot avoid looking into China, which is adding huge capacity in each of these areas that we are talking about. Therefore, whether these companies will make money, whether they will sustain and grow on top and then keep further investing, because all these incentives cannot become bigger, right? Then it starts hurting the fiscal. So government is taking all the right steps to initially give the support, and that will enable manufacturing to grow at a decent pace. That should, in my opinion, enable the country to grow between the range that you mentioned, between 6 to 7%, slightly higher in the initial period, but sustain at somewhere like 6%. And in that period, with a 4 to 5% inflation, we're looking at a 10 to 11% sort of a nominal GDP growth rate. And when that happens, we feel that there are 3-4 themes that will work really well. Whenever countries go through that large amount of growth for a longer period, which is when they lift from mid-income growth countries to high-income growth countries, you will see certain sectors and themes playing out very well. One of the things that plays out is the contributor of that itself. That is the manufacturing, which will drive job growth for a country. 10 crore working population will get jobs. That itself will lift a massive amount of population to the higher income level. Second you can play directly in the manufacturing companies, but you can be very specific because valuations have also gone up significantly in manufacturing space. You need to be selective, but I think there are enough opportunities to play that. You cannot be broad-based here, but you need to be very selective. If you look at whenever the income level increases, there are two sectors which benefit in a big way. One is financials, because many households become bankable. Before, they might be sourcing all these loans from the local lenders. So formalization of retail lending happens in a big way. This has happened across all the countries whenever the growth rate have been very impressive. So in India also, we think segments like affordable housing, used car financing, small ticket labs, unsecured lending, all this will have a significant growth. If the nominal GDP is going to be 10%, I think retail credit itself will grow 16, 17%. And segments like this can actually grow for 25% for the next 10 years also. So our focus has always been that can we get these ideas, invest into them. Look at a case that India will growing at 6% and 7%, and you will have companies which are growing at 25% loan growth for the next, say, 5 to 10 year time period. What kind of value they can create for you? They are very specific, right? It's not about investing into the index. You don't have any of these names in index, in the Nifty index. You are probably having some of them in small cap index or in the mid cap index. So it is all about being choosy and being in the segment that you want to be. So this is on the financial side. And as more people earn more income, you will see urbanization happening. When urbanization happens, people spend on what? They spend on education, health, entertainment, travel. So if you are investing in consumption, I don't think it makes sense to invest further and further into FMCG companies. You can make money in the short term, but if you're taking a 3 year view, 5 year view, I think the high growth is going to be in discretionary. And in discretionary, if you choose the right stocks and sit on them, then you make a lot of money, like what we have done with Titan and Trend and Zomato. We have invested into Trend 5 years back when nobody believed in the story. Titan, same. We've invested it 7 years back, and we have made phenomenal money. Both of them are 10 baggers for us. Recently, we added Zomato, and in the last 1.5 years, Zomato benefited again because of the consumer story. And now you can see their profitability is improving much better than what the market expected. So once you get this long-term trends right and sit on the right stocks, I think there is a lot of money to be made. As an house, we believe in beating the index in a meaningful way. I think next 3, 4 years, as these ideas plays out, you will see that helping us. So for the investor, what I would say is, if you are a passive investor, you have to be careful because the earnings growth trajectory from here is not going to be largely broad-based. It's going to be specific. You can't expect FMCG companies to grow and discretionary companies to grow. It's going to be more towards discretionary companies, and FMCG companies will grow slowly. And if you take IT companies, they are going to go through a year or two of slowdown because of global issues. So earnings growth for the next 1 or 2 years is going to be patchy. And if you take a 5 year view also, there are segments which will underperform significantly in terms of earnings, and mostly traditional sectors and new age sectors which will define the new India and contribute to the next $3.5 trillion of economy in the next 7 to 8 year time period. I think that is where our focus is. And that, I think, always is an area where in the long term will beat any of the other passive funds or index in a meaningful way, in our opinion. So if you're an active fund manager focused on these areas, I don't think there's a risk. But if you are a passive investor who benefited from large swings in index, which was outcome of large swings in flows and macros, then it's better off that you start getting into some active fund managers and taking their help. Obviously, last 3 years was not a great year for active fund managers. So most of the investors feel that there is no need for research. So that will change in the next 3, 4 years. I think the opportunities do exist, even if India grows at 6%, but it's all about selecting the right stocks and the right themes. So that, I think, will help you understand where we are coming from. That although we are conscious about the risks which are there, but those risks, I think, is mostly related to investors who are investing at the index level. But if the investors are stock specific, stock selective, bottom up, the approach that we have always, I think that's a space which will start looking attractive from the next, say, 3 to 4 year time.
So you made a mention of valuations. Now, while there is some talk about earnings growth in the markets, all one gets asked in the markets today are valuations, valuations, and valuations. A combination of monies piling into passives, index compulsions, etc., pushing many to move up the cap curve into large caps from mid and small. Now, with the market momentum, what it is, growth drivers still firing, what would your advice be on this? Should people move into large caps from mid and small? How would you look at this issue?
I say there's a famous quote of Warren Buffett, which he made during 2008 financial crisis. He said, "When the tide goes out, only then you will know who is swimming naked." So, it reminds me about uh, all this overall view that people are trying to take on the market because of flows being very strong and trying to paint the same picture across. That sometimes it will hurt you. And that's why we always emphasize on this point that be selective and be the opportunities are going to be selective. To the question that you asked, a very relevant question that I also hear in many forums, that people are being advised to shift out of mid and small cap to large cap. This will work only to the extent that you try to protect your money. Per se, whether large caps have potential to deliver an outsized return, the answer is no, because our initial internal assessment from a year perspective, this is not a long-term view. Obviously, when I give views on indexes, I don't go long-term because it is all about what people want to do at a passive level on index, right? When they want to be serious about equity investment and looking at long-term, then I think always the focused approach always works. So when people ask us about index move or large cap to small cap to mid cap, they're all trying to ask at the index level and mostly from a short-term perspective to time the market, which is always very difficult. In that perspective, I would say there are risks in the market. The people are advising this primarily because mid and small cap, the valuations are very high. Despite the earnings growth is not going to be much better than the large caps, which is what I told you before also. But you have to understand this much more finer. You have to break it down. If you look at large caps per se is dominated by not so high growth sectors in India. You have only banking, which is 30%, and then L&T, right? Beyond that, in the index, you don't get many manufacturing companies. You don't get many capital goods companies in the Nifty. Many of them are in the top 100 to 200 stock or mid and small cap stocks, probably. Given that there is a tendency, last year there was a tendency to ask people to invest into mid and small caps, and people invested heavily into mid and small cap. Now that has led to a higher valuation for mid and small cap. And if the mid and small cap, if you see, there are two buckets. There is one bucket which is an India growth story, which is what we are interested in. There is another bucket which is a sector or stocks where these have become mid caps because they have underperformed for so many years, because they are losing market share to the large cap companies. Classic example of this is banks. PSUs have lost market share to private banks in a big way, and they've become mid caps mostly, or some of them are still in small caps also. Now, if you're looking at the overall growth perspective in the mid and small cap space, it is an average of all this, right? There are certain high growth sectors which are attractive, but there are equally those companies which are not growing faster also. An average of that is leading to mid and small caps as an index is not delivering a higher growth rate than the large cap. Neither the large cap is looking great also. It is single digit earnings growth is what I think will happen, because 70% of large cap is likely to deliver less than 10% growth. And our average expectation for that 70% of the Nifty weight, it includes banks, IT, FMCG, all these sectors. Even auto sector in the Nifty will go through earnings being tight. Last year, it did really well with the help of margins. When all this is happening, I think more than 10% growth looks difficult for Nifty. And very similar is the case with mid and small cap. And now, if the earnings growth is same and valuations are high in mid and small cap, it is natural for anybody to say shift out of mid and small cap to large cap. I would rather argue the other way. You pay attention to stock specific, and there are many mid and small cap companies where the earnings growth is much superior because they are a play on the India growth story. So the best way to allocate right now for the retail investors is to focus on multi caps and also play those fund managers who are having a focused bottom up sort of a view on the market and adding stocks accordingly. If they are very diversified, investing into 70, 80 stocks, again, it will hurt them because the tail will hurt them. So it is all about what is the sweet spot. The sweet spot, in my opinion, is investing about 30, 40 stocks and being very specific. We invest only into 20, 25 stocks maximum. So I think the sweet spot lies in being very selective and specific. It's all about being selective. I don't think this cap curve shift from small and mid cap to large cap really helps if an investor is coming into the market today from a long term perspective. If he's trying to make money between large cap and small caps from a short term perspective, probably this can help. More so if he wants to protect his money for a year or so. But I think better way to do this is if you like stocks where the growth is going to be very strong and they are playing the India manufacturing story or India consumption story or India financial inclusiveness story, any of these, and they are available at a reasonable valuation, I think the investor will do well by selecting those stocks and playing on the dips. Whenever the market sees some volatility, that should happen in the next 6 months to 1 year, you will see market being very volatile. So buy on dip will be a very good opportunity. Buy on dip, don't expect any return in the first 6 months to 1 year. Then just see how that portfolio will do for you for the next 3 to 4 year time period. So that is a better opportunity rather than saying, okay, mid and small cap is costly, let's move to large cap. Neither large cap is looking very attractive from an earnings point of view. Then again, you keep shifting from one bucket to another bucket. I think that's where the role of an active fund manager comes, and that's where it's better that since you have made money in passives and large diversified funds, it is better to shift to some fund manager who will able to handhold you and build upon this for the next say 5 year or so in terms of creating wealth. I think market these conditions are changing, playing conditions are changing. The investors have to understand this and accordingly change what style fits them rather than thinking that passives will continuously keep outperforming. And that will change, that will go through a change. So that's what I would say. That answers your question also that whether large cap is a better place to be. Actually, I disagree with it. It's all about being selective across the cap curve, large cap, mid cap, and small cap, but being very stock specific and not investing into the index level.
So, in short, what you're saying is horses for courses is what broadly you're saying. Yes.
So, Arjun, we discussed about the India growth story. You gave your opinion, very interesting ones, which also aligns with our thought process on India growth. But more specific about macros, we also have a view on what is going to happen on the interest rates and inflation. Any view that you want to share with us on the interest rates, Fed? What is Fed action likely to be from as we go from 24 to 25 also? What can happen on the interest rate side globally?
Sure. So the last 2-3 years have been very, very eventful and very interesting. So you started off with COVID, and then after COVID, you had a lot of concern in the markets about the amount of spending the US was doing. Then a couple of years after that, the markets were guessing when the US was going into a recession. As the markets were guessing this, you had the Russia-Ukraine war that had sort of exacerbated already prevalent inflation. And then you had Israel-Hamas issues. Then you had the markets coming to terms that maybe the US is not going into a recession. And then they shifted views saying, okay, no, there's not going to be a recession. It's going to be a soft landing. Now, in all of this, the markets continue to sort of second guess the Fed. They started guessing that the Fed would start its rate cuts around March of this year. Now they're shifting to around July, sometimes September. And there are even commentaries from the Federal Reserve themselves that probably it might be December this year. So the markets are in this constant guessing mode as to when the Fed is going to start cutting rates. Now, as investors, we are in the job of sort of creating wealth. So timing the exact point as to when the Fed will start cutting rates is broadly very futile because we are actually in this for the longer haul. What we really know from a macro framework point of view is that growth will slow down globally and the Federal Reserve has to start cutting at some point or the other. It can be H2 of 2024 or it can be H1 first half of 2025. But the direction is very clear that growth will start slowing down. Inflation is coming off. Inflation is much more manageable sort of levels, and central banks are increasingly warming up to the idea that they have to start easing as growth starts easing as well. So I think it's this broad directionality that we should actually be looking at rather than any specific timeline as to this is exactly when the Fed is going to start cutting rates. So when the Fed starts cutting rates, it might probably be a 2 or a 3 year cycle. And India will also mimic pretty much the same. as long as there aren't any other geopolitical events or other disturbances that sort of impact the growth story in India. So I think, long story short, I think it is the broad framework and the directionality of the rate easing cycle that one should be looking at, rather than whether it's going to start in a July or an August or a September.
Great. And that's exactly what I tell my investors also, that if we are arguing that Fed will not cut the rate, then the discussion is different from a short-term perspective. And if we are arguing that rate cut will happen, but we don't know whether it's going to happen in H2 or H1, H2 of 24 or H1 of 25, then the direction is set. The direction is at some point of time, rate cut is going to happen. Then it's all about timing the market. So investors are trying to time the market. I think that is not the right way to approach long-term investment in equity. Obviously, when the rate cut happens, I think it helps growth investors like us who are investing mostly into companies which are dependent upon growth in a particular economy. So we are betting on India's growth and sectors which will contribute to this growth. So I think once you believe that the rate cut will happen at some point of time, it only adds to the already positive trajectory the earnings are for these companies, in our opinion. So that's nice to hear that you feel that rate cut, once it starts, it continues for 2-3 years. Might be the phase of the rate cut might be differing, and the starting point might differ, but it generally takes a direction. That's a very nice thing to hear, and I think it's very important to take for the alternate investors also. That sets a stage for you, right? What to look for from the macro point of view. Beyond that, I think it is all about stock selection. Even the macro is about an easing rate cycle and it is about growth orientation, then for you, it becomes easier to bet on companies with the growth as a thing, and then moving away from companies which are slow growth but dividend yield sort of approach, which has worked well last year, right? So I think that is a playing condition, another playing condition change that I'm always referred to. So once the trajectory is about rate cut, I think a lot of it changes. So nice to hear that, Arjun. And I think it's always wonderful to speak to you and hear your views on economics. And we also take that as an input to us. But obviously, as a equity fund manager, uh, macros are important, but the most important thing is selecting the right stocks within it, because here the investor is for the long-term perspective. So it's good to hear your views, and thanks for it, and thanks for hosting me in the show.
Pleasure was all mine, Madan. It was a pleasure to really have this discussion with you on Market Thalaivas.
Thank
Thanks
you.
a lot. Thank you.
Market Thalaivas brought to you by Sundaram Alternates.